The broadcast is now starting. All attendees are in listen-only mode.
record. Afternoon, ladies and gents. Thanks for tuning in to our lunchtime webinar with Easy Equities. It seems like you guys have all followed the new link, so that's great. If you can please raise your digital hand to just ensure that you can hear us properly. You should see it in your panel. There we go. And if you have any questions while we're chatting, please pop them in the question bar. Or if you're struggling to hear us, then please can you just let us know. Just want to make sure that everyone can hear us. I think we've got most people. 20% is the majority in some countries. There we go. Fantastic. Well, thanks so much for joining us today at lunchtime. As per usual, we're going to try and keep it short and sweet, and then we'll open the floor up to Q&As. We've got Sean and Waylon from Easy Equities and myself, Chris, and Greg from Coreshares here. So if you've got any questions that are either platform related in terms of trading, etc., fire away because we've got the experts in the room. And then, of course, if you have any ETF related questions or investing questions, please ask so that we can try and help out where possible. Of course, this webinar is being recorded, and the guys from Easy Equities are going to circulate it. So if you have to dash out or if you want to forward it on to friends and family, etc., please feel free to do so. As I mentioned, my name's Chris and I come from Coreshares. We're an ETF provider on the local exchange. I hope you guys are buying our ETFs and you know all about us, but otherwise go to our website to find out more. Today we're going to be chatting about the 3 little tips of investing. Now, 3 little tips. Of course, our marketing team was having a field day at this point in time. So they got the pigs because of the piggy bank and because you can save in piggy banks and because there are 3 pigs and we've got 3 tips. So it was very clever. But really, these aren't little tips. These are really important investing principles which are fundamental to your long-term success as an investor. So, you know, as much as the title is catchy, I really think these are fundamental investing tips that all investors, from guys investing $100 a month to investors who've got 100 million rand a month, institutional investors, should be following and in fact do follow. So really important investing tips that we're going to take you through here. So as I mentioned, shout if you've got questions. It's usually best to take the questions towards the end of the webinar. It just flows better. So if I go through the webinar and don't answer your question, wait till the end. If we see questions that are really relevant to a point in time, then I'll take them. So the first tip or first important principle of investing that we believe in and that we're going to show you has evidence supporting it is that keeping it simple is smart. So when we say that, what we mean is simple investments are often the best investments. And really the question is, well, then what is a simple investment? So the simplest investment, I suppose, is just to go onto the JSE via your platform, via your stockbroker, and buy a share. Just buy Naspers or BHP Bill or Richemont. And I guess that's kind of where it starts, is the investment world. And the question is, well, if there are 160 really liquid shares, the all share, we would say there's probably 50 genuinely liquid shares in the market. Well, which one do I buy? And this is where it really becomes tricky. So you've got such a plethora of choice. The challenge of investing is which stock to pick, which actual share should you pick to deliver your particular outcome. And of course, typically when we're buying equities, the end goal is to grow our wealth and to give ourselves opportunities through wealth growth. So what happened in the 1940s, 1930s is that a whole lot of investors just were buying shares, picking shares. And then a few clever guys, Bill Sharp, etc., came up with a strategy that said, shouldn't we measure how people are doing? Shouldn't we see at least whether or not our investments are doing well? And what they did was they said, well, to establish if we've done well, if our stock pick of Naspers and Richemont and Anglos were actually good, were to be measured against the whole market. So say, what is the opportunity set? And let's see if we've beaten that. And how that was typically done was through what's called a market cap weighted index. So a market cap weighted index is basically a portfolio that gives a share its contribution based on the size of that share. So the biggest shares get the biggest weight in the portfolio. So Naspers and BHP Billiton, we know, are huge shares in our market. They get the biggest weight all the way down through to the tail, where we can see Growth Point there at 1.25% of the portfolio. And really, that's the opportunity set. So this is an opportunity to buy the market, essentially. And this is what people started using to measure their investments. Was their 5-stock portfolio, their 10, their 20-stock portfolio actually doing better than just buying the market? And what was very interesting was that although it may seem very easy to beat this particular market, that very few investors were in fact beating the market. But now at this point in time, it was just an index. It was a theoretical measure of the market, and you couldn't really buy it. And then a few guys, John Bogle with Vanguard, and in South Africa, the early movers in our market, Satrick, said, well, let's package these index, these theoretical portfolios, into exchange-traded funds. And let's make it easy and cheap for investors just to buy the market. You can imagine if you want to go and buy 50 stocks, you're paying across 50 different brokerage rates. It's quite complicated. The variable percentages are changing every quarter. So you've really got to be on your toes to get this exposure. And so what an ETF does is it packages this basket of shares, let's call it a representation of the JSE, into one simple security or one share that you as an investor can simply buy with one trade on your Easy Equities platform, etc. So this is an example of a Coreshares top 50, and this represents the 50 largest shares. And the only kind of rule here is that the largest shares capped at 10%. So from a diversification perspective, we say it's not that smart to hold a huge percentage in one share. And the problem in our local market is Naspers is 25% of some indexes. So, and this can be bought through an exchange-traded fund. So it's exchange-traded. In other words, you can buy it through your Easy Equities platform, and it's a fund. So you actually, by buying one shares, are getting a basket of shares. So what's the trick with this? What's the whole story here? And this is the real story behind this keeping it simple is smart message. So as simple as it may seem, just to buy this market, not to try and be clever and pick a share one over the other, is the reality is that it's very difficult to beat this simple market. So this is research that's done by S&P Dow Jones. Anecdotally, the ETF that we have, our top Coreshares Top 50 ETF, tracks an S&P Dow Jones index. And what it shows is that 93.2% of funds underperform the simple market index. So in other words, as simple as it may seem just to buy one or two shares and outperform the market, the reality is that 93.2% of investors underperform this simple way of getting investment exposure, the simple way of investing. And the surprising fact is that these are professional investors. So this is not, a first-time investor trying to pick stocks who's actually works in a marketing company. These are the smart guys in the room. These are the actuaries, the CFAs, the CAs, the MBAs, the doctors who really struggle to outperform these simple investments, these market cap weighted investments. So the question you have to ask yourself as an investor, who maybe researches stocks for a couple of hours a week or a couple of hours a day even, is that can you beat this simple form of investing? Are you adding value by stock picking, or are you actually detracting value? And these are the results of the professionals. So the reality is that a simple investment is actually a smart investment. And Leonardo da Vinci said that simplicity is the ultimate form of sophistication, and in investing, it truly is. So, if this is so simple, is everyone doing it? And yes, that's what's starting to happen. We're starting to see exponential growth in the ETF market, both locally and abroad. Abroad is where it is kind of in the trend of ETFs, is where it's growing the fastest. And a number of kind of global thought leaders have come out saying that these simple investments are the way to go. Warren Buffett advised his trustees, and he has a massive trust, as you can imagine. He's one of the wealthiest men in the world. Said, just put 90% of the trust's money into the S&P 500, 10% in cash, and forget about it, because the reality is that active managers, guys trying to beat the market over long periods of time, really struggle to beat the market. And they struggle for a number of reasons. We'll get into some of those reasons. But what we're seeing is huge growth in the ETF market. Our top 50 ETF, as an example, we only launched about 3 years ago now, 2-3 years ago, and we just short of R1 billion in that fund. So the growth from a relatively new fund is coming through. People are recognizing the benefits of that fund, and it really is consistently a top performing fund. If you compare it not only to novice investors, I'll call it, but to professional fund managers, it's consistently in the top tier of funds from a performance perspective. And of course, it's diversified. So you're diversifying across a lot of stocks, which is a massive benefit. So for that reason, we believe that the core and principle number one, keeping it simple and smart, really has a lot of evidence underpinning it. By the way, this is consistent. We've actually got graphs through time, which shows you the numbers. This is actually particularly high. The number is on average around 83% in South Africa of professionals who underperform a simple investment. And really, what we're seeing now is the growth of passive, the growth of what we call rules-based investments. We don't think they're passive because there's no such thing as a passive investment. Every allocation is active. Every allocation is intentional by investors. And what it really represents is a democratization of investments, which brings me on to our next fundamental principle. And one of the reasons why why passive or why ETFs have democratized investing is because they're packaging these funds at institutional style fees. So traditionally, if we went and saw a pension fund, they would say, okay, we've got 10 billion rand for you to manage. Will you do it at 20 basis points or 0.2%? We'd say, yeah, that's fine. That's fine because you've got a lot of money. But if you're a retail guy, man on the street, and you're giving us $100 a month, and it's still happening in our industry all the time, the average fees on portfolios are around 1.5%, 1.6%. That's the kind of fees you have to pay. But what ETFs have done is it said, well, we're going to package these ETFs at 0.2% or even cheaper and give it to access to you as investors so that you can access it at the same fees that these large pension funds manage it. And that's not lip service. We literally manage pension fund monies at 20 basis points. And that's the same fee that you are getting as a retail investors. And so that's why it's democratized investments. It's giving everyone the same opportunity to get these very low fees. Which brings us on to our next part of the thing, and that's keep more returns for yourself. And really, keep more returns for yourself is our second fundamental principle. And you'll see they all interlink, they all feed into each other. And the principle is that over long periods of time, costs erode your returns. So Morningstar Research, who is the largest researcher into fund management, into asset management in the world, has done research both globally and locally. We've referenced it at the bottom. And the kind of outcome of that research was the single largest determinant of a fund's future success are the costs it charges. So in other words, when you're looking at what fund to select, more important than establishing whether the portfolio managers are CFA charter holders or actuaries or doctors, or whether they are stock pickers or style-based investors, or whether they've got a team of 50 analysts or 3 analysts, the most important thing to look at simply is the cost it charges, the TER. So look at the TER and try and establish if the costs are very high or relatively low. And the kind of theme is that a high-cost investment will typically underperform a low-cost investment. This is not a passive versus active or an ETF versus active debate. This is an investment debate. So what it's saying is that if you're looking at active managers exclusively, you're better off buying a low-cost active manager than you are buying a high-cost active manager. Now, the typical experience for investors is that ETFs, rule-based investments, are low-cost investments, and that's why they're so user-friendly for clients. So the importance of costs is something that really should not be underestimated. In fact, these are another few global independent thought leaders who are way in on the topic. John Bogle has his cost matters hypothesis. He's the founder of the largest asset manager in the world. And the cost matters hypothesis says that regardless of market conditions, regardless of interest rates, political environment, Cost is a constant in your portfolio. And so it will always matter, regardless of, as I mentioned, market regimes, bull markets, bear markets. So it's a fundamentally important and structurally important component of your portfolio, so it shouldn't be ignored. William Sharpe's got something called the arithmetic of active management. Basically, it says that costs, again, are a given in a portfolio. So if you took all monies managed, you split it in half, half were low cost, half were high cost. The low cost manager, on average, will outperform the high cost manager. And that's simple mathematics. So, these are really important fundamentals of investing. Again, Bill Sharpe, who's a Nobel Prize winner, weighed in and saying that a low cost saving client will have a much higher standard of living than a high cost saving client. So let's give an example. What is the importance of costs? Let's see how these costs erode returns. This is a very simple example. You're a client, you've got 100,000 Rand, you want to invest it over a period of, say, 30 years. You want to make a selection between two funds. One is passive, just giving you that simple market, and the cost is 0.3%. The other is active, and the cost is 1.3%. Now that, by the way, is below the average active fee, and that's above the average passive fee. So, this is biased and very neutral. In fact, towards active. But the idea is that the difference in costs over your saving is 1%. So it's a simple 1% difference. What's really important to consider here is that active at 1.3, only 10% of these active managers will actually outperform this passive management fee. So you've got two risks here. One is that you're running a high-cost portfolio. The second is that you select a manager who will underperform over your savings period and actually detract more value than what's in this example. So your lump sum's 100 grand, and let's have a look at what the detraction of returns of a 1% fee differential is. So this is just simply 1%. And you'll see the impact of compound over long periods of time becomes more and more significant the longer you hold it. Now, typically, our retirement savings are 30-year periods. So the most important probably savings component that we have is very long-term in nature. We may invest when we're 30, but we're going to retire when we're 65. In fact, there's a lot of question marks in the investment industry by investment professionals to say, are people going to retire at 65 if we're going to live to 120? The adverts now, they're saying that the people, that the person who's going to live to 200 is alive at the moment. So are we going to retire at 65? This 30-year savings horizon might actually be 40 or 50. But let's have a look at this. And the difference is significant over a 30-year period. By the way, this is the best. 90% of active managers would underperform this. So in other words, they're going to be somewhere below here, which is quite staggering. 10% will be somewhere above here, but can you really select them in advance? That's the challenge, and that's the huge unknown. So the amazing thing is that the differential becomes so significant the longer your investment horizon is. So an 850,000 Rand difference on only a 2.8 million Rand investment at the end of the day. And this is 100,000 invested over a long period of time. And again, I want to emphasize that the difficulty is actually selecting active managers who are this good to just get to this 2.7 million Rand amount. So this fundamental principle number 2 is keep more returns for yourself. Why pay away high fees when there's no evidence that those fees are going to deliver you anything that's better than the market? In fact, the evidence suggests that it's going to deliver you less than the market. And those fees are the same for trying to churn a portfolio, trying to do your own active management. You tend to pick up more. STT is the biggest fee. I mean, a platform like Easy Equities is really inexpensive to trade, but you mustn't forget you're paying government taxes every time you trade. So you're paying 0.25% just in tax, excluding capital gains tax, when you trade a security. So that 2.25, if you're turning your portfolio twice a year, suddenly 0.5% of tax erosion. That's not even capital gains in nature. This is just some research on the average passive fund at 0.26, the average active fund of 1.57. So as I said, we actually made the passive fund more expensive and the active cheaper to try and give active a chance, but they really struggled. So the important thing here is that principle number 1 was keeping it simple and smart, and this is the simple investment, ironically. 90% of active managers over extended periods of time will underperform the simple investment, and keeping more returns for yourself is a simple principle, and what that translates to is getting your costs low. So trying to get this 0.26% as a fee is very important. So that's kind of our second principle. And the third is timing the market, time in the market, not trying to time the market. And this is probably the biggest temptation for investors. I often like to refer to a presentation that I've seen with articles from the Wall Street Journal, which is kind of the premier investing journal in the US, 2010, 2011, 2012, 2013, headlines every time of this period saying the easy money is over, markets are expensive. And what's happened to those investors is that you've seen that they have significantly underperformed the market if you moved out of equities. And really what it says is that one should spend time in the market as opposed to time in the market. But again, as an investor, this looks easy. Surely I just buy somewhere over here, 1994, and I should sell here 2001, just before the tech bubble, because everyone could see the tech bubble coming. That was easy. Sell out and then buy back in 2000, and sell out before the global financial crisis, and then buy back in at the dip. I mean, look at how easy that is, how obvious it is. And the reality is that it's not easy and it's not obvious. In other words, we could have suspected that this was a peak, but perhaps it's not. You've seen markets have run again this year. In fact, research shows that even expert market timers are not able to predict the markets accurately enough. In other words, they're not able to predict the highs to sell and the lows to buy accurately enough to outperform the market. Their attempt to time this market ends up in them underperforming, just buying and forgetting about it over long periods of time. Even as I mentioned, there's quite a few of these global thought leaders. Benjamin Graham, who is Warren Buffett investment muse and his inspiration, says that market timing is a losing game. So the reality is that it's very difficult to time markets. And one of the reasons why it's so difficult is because we don't have crystal balls. We can't predict what Cyril Ramaphosa is going to say, or Donald Trump's going to say, or the Turkish president is going to say, or anyone is going to say that could impact our markets, or what the Fed's going to do from an interest rate perspective, or are we going to nationalize our banks? These things are very unpredictable, and what that means is that returns are volatile. In other words, equity market returns are volatile. In other words, their price moves around a lot. And so the risk is that you are not in the market in the good months. So this gives you an idea of people trying to time markets and missing the top 12 performing months over a 10-year period. If you just missed 12 of 120 months, the best months, over a 10-year period, your return would have been negative 0.62%. If you just bought and forgot about it, your return would be 8.1%. So from a negative return, if you just bought and forgot about it, you would have a significantly higher performance. So the kind of moral here is that you've got to stay invested, because you cannot afford to miss out on these good performing months. And the kind of trend is similar on an absolute deviation basis. So in other words, there's a 5% difference here, there's a 4% difference here of underperformance annually. So 4% underperformance annually over 130 years, that is over 30-year period, apologies, that is a significant underperformance. That means you're going to underperform cumulatively, very basically, by 120%. You're going to have half the money if you miss those 12 of 30 times 12, what's that? 360-month period. I mean, that's a very low amount of months to miss, and to miss out on such a huge amount of your performance. So the truth is, time in the market is the way to go. Do not try and time the market. This is especially true for investors doing monthly debit orders, where you're just getting average pricing through the time. Don't say, whoa, I'm worried about valuations, I'm doing $500 a month debit order, I'm going to stop that. The discipline of investing consistently is more important than trying to time the market. And the reality is even if you are investing a lump sum, you should just be invested in the markets. So that wraps up our 3 important investment principles, or as our marketing team likes to call it, the three little tips of investing, I think is what the three little tips, a trio of simple investing principles. They are simple, but they're really smart, and they really will improve the outcome of your long-term investing success as an investor. So that wraps that up. As I mentioned, we're going to do some Q&As. There are a couple of questions saying, is this recorded? They came in a bit late. And yes, it's recorded. The guys are going to send it around. I just want to try and make the question bar a bit bigger so we can read it. So please fire any questions away. We don't have any questions yet, but as per usual, we'll hang around and wait to see if there are any questions. As I mentioned, it doesn't have to be something about the webinar. It can be about an ETF that you're interested in. It could be about the platform's capabilities, the bundles, etc. that ETFs, that Easy Equities has. So please fire away. And thanks for joining us. These webinars also will be available on the Easy Equities YouTube channel. So if you want to forward it on to friends and family, if you think this is, if you're trying to tell, often it's a generational thing. The millennials tend to catch on to the ETF trend very quickly. But the guys, your generation in front of us, our kind of elder generation struggle. So if you want some stats to fire away at your mom or dad because you were telling them they should disinvest from the expensive active managers and buy ETFs, here the stats are forwarded on. Any tips for the short term, less than 3 years? So yeah, we did focus a lot on the long term here. When you come to short term investing, what you really need to focus on is asset allocation. Now that sounds really fancy, but what it means is that you need to invest in assets that are more appropriate for the short term. So if you have a 3-year horizon, you're more better served investing in either a fund that's low equity in nature, so a balanced fund. I know you can buy balanced funds, balanced type funds on Easy Equities, or invest more into bonds or money market type investments. 3 years is a bit longer than a typical money market allocation, which would be 1 year, but you want to invest essentially in less risky assets. And the reason is because of the volatility of the investment. So investments in equities move up and down. Over long periods of time, there's evidence that an equity investment will outperform bonds, cash, any other alternative. So you want to be in equities. And the longer you stretch it out, the less likelihood is of negative rolling returns. So in other words, if you invest in bonds over 3 years, there's a high probability your returns will be positive. But if you invest in equities over a short period like 3 years, there is a probability that you'll have negative returns. So short-term investing really comes down to investing in the right asset classes. So cash bonds is more appropriate for short-term. So I see on Easy Equities there are 10 different Coreshares ETFs. Which one does one choose? So the reason why we have all these ETFs is because investors have different needs and different requirements. Zane said he's looking for a 3-year investment horizon, so he might want to pick a bond ETF or something like that. He might be retired, so he's looking for a dividend ETF. So all of our different ETFs really have different roles to play for different investors. The kind of message that I was talking about today, the keeping it simple is smart, would be an ETF like our top 50 ETF or our S&P 500 ETF, where it's just simple market cap weighted, it's low cost, and you're just getting exposures to the market. There's a lot of evidence to say that that will do well. For example, we have other ETFs like a Dividend Aristocrats ETF. That's probably more geared up for your retired client who's looking to generate some income in his portfolio because he's got an income requirement out of his portfolio. So it really is a different strokes for different folks kind of approach. We have property ETFs, which if you're looking to generate income, again, if you're retired, makes a lot of sense and can be used as an asset allocation tool. So yeah, we've got a number of ETFs, but it's really a different strokes for different folks. We always say this, but investing in ETFs is not an easy game. So feel free to reach out to us, or to advisors, or to ETFSA, and ask any questions. Let's see, we've got a few more questions. Sorry. Where I see on each, sorry man, this keeps defaulting up. I'm a beginner. As an example, I have no idea what low vol tracks is or prop tracks means, as well as the others. So you don't have to worry about low vol tracks. That ETF's actually been discontinued. It no longer trades on the markets. All of our ETFs have literally libraries of information sitting behind them. We try to give away about the strategy and the name. So low vol was actually a low volatility investment theory. So hence low vol. Prop tracks is a property tracker, so hence prop track. So we do try to give away what's in the fund in the name. For example, top 50 just buys the top 50 shares on the market. But really, there's loads of information. If you're looking for more information, email us. PropTrax, as I mentioned, 10 is a property ETF that buys the 10 largest property companies. So we try to keep it as simple as possible so that investors understand. But please check out our websites, email Easy Equities, email us. They do research on these ETFs. We do research. So please reach out. What is the minimum amount one can invest in an equity ETF for the long term? Well, and what's the minimum debit order?
There is a minor recurring investment cost. There's no minimums, obviously, but just keep in mind that that recurring investment cost is there. So it's 10 basis points. But you can set up a recurring investment from 10 Rand, 50 Rand. So
they really, I mean, the kind of the message there is there really are no minimums. I mean, even if it's 50 Rand a month or 100 Rand a month, to get started. And remember, what's important is to adjust that upwards as your salary grows, as you get a bonus, as inflation grows. You need to keep moving that up as you have more money to spend. If you're paying off debt, once you've paid off your debt, increase your debit orders, substitute your debt repayment with an investment. That's really how you empower yourself and how you grow your wealth. So the minimums, fortunately, because of businesses like Easy Equities, there's no more excuses for us as investors to say, no, it's too, I don't have enough cash to invest. There's really no reason why we can't. What platforms will you recommend? No comment. I'll hand over to Easy Equities. I would recommend Easy Equities. But other than that, there are a lot of other platforms. What you need to understand, I suppose, is are you looking for advice? Is there advice platforms? What are you looking for? Are you looking for low-cost investments? Easy Equities are super interactive with their clients, so that's great. They educate their clients a lot. They do webinars, etc. So I would say they're right up at the front, best in class in terms of reaching out and helping small investors, which is really how they've differentiated themselves. So check them out.
And also, because we're just amazing. Okay, we make it so simple and so easy, and you've got access to a lot of people that really knows their stuff in the industry, and they assist with education, and that in itself, because you're a new investor, you need to educate yourself around what investing is, what sort of products you should be looking at, and that's why we have access to this fabulous oaks from Coreshares or Satrix or any of these people who's leaders in the market that makes it so much easier for yourself. We're just a platform where we provide you with access to all of their products.
Great, we've got more questions. Keep them coming. Why would I buy the top 50 and not a top 40 equally weighted? So top 50 is, as I said, kind of the simplest avenue into the market. It's got a really smart rule which caps the largest exposure at 10%. So if you're not trying to seek a specific outcome, except just equity returns, top 50 is kind of the default, I would say. Relative to, I know you've asked relative to top 40 equally weighted, but I'll answer relative to top 40. Top 40 is uncapped, so in other words, you can get very large single stock exposures. Naspers is up at 20%. You don't really want that from a diversification perspective. And you get an extra 10 shares. So relative to a normal top 40, that's the big difference. But but quite similar. Top 40 equally weighted is a very specific risk management tool. If you're looking to diversify away single stock exposure, then yeah, an investment into the top 40 is a good idea. The equal weight methodology means each share gets an equal weight, so you won't have 10% in an Naspers or BHP Bull, you'll have 2.5%. So it's a good risk management tool, but you have to understand as an investor when you're doing that, you're deviating significantly from the market. So you will have periods of underperformance relative to just a simple market and periods of outperformance. So you need to understand what you're investing in, what you're buying. When you buy a top 40, you're taking a bet on the smaller shares versus the larger shares. So you're taking more of a mid-cap bias. So you'll be underweight Naspers, Richemont, BHP Billiton, British American Tobacco, etc., and overweight some of the smaller shares in the top 40, the Mondis, the Sappies, etc., etc. So you're making an explicit choice to, when you're investing, buying the top 40 equally weighted. That's why we kind of talk about the top 50 as just the default investment and as a great investment proposal. Also because it's got that slight risk control of 10% cap, which kind of is a best of both worlds, we think, when it comes to investing. Another question, what are the top 10 shares I buy at the moment? Well, I would say if you're a novice investor, start with an ETF. Buy a top 50 or a top 40 equally weighted ETF. Hold that in your portfolio. Hold it as the core of your portfolio, if you want to call it that, and really spend a lot of time doing research until you pull the trigger on buying one share. I wouldn't recommend an individual share to an investor, to in fact any investor, man on the street, an expert, because the reason is that the evidence exists that guys can't select shares and outperform the market. So really, I would not recommend you try and stock pick, especially if you're new to investing. And if you do stock pick, please diversify away as much of your risk as possible. So, I mean, we would say you want exposure to at least 50 shares, 40 shares. And because of events like Steinhoff that we had last year, let's say you stock picked and you selected 3 shares and that was 1/3 of your portfolio, you can lose that overnight. Steinhoff, don't forget, everyone knows it as the big bad corporate who was involved in some kind of fraud scandal. But 1 week before that, the best investment professionals and investors were buying the share, saying this is the darling of the JSE, this is the best share. So, we don't have a crystal ball, so I wouldn't recommend stock picking at an individual level. And if you're going to partake in stock picking, really try and diversify away your risk. And one easy way of doing that is buying an ETF. So let's say you do really like, let's say Richemont, because they've got all the luxury brands and you think it's a great story. Why not buy that as 10% of your portfolio and then buy a top 40 equally weighted as 90% of your portfolio? Why? It's not an all or nothing kind of example. So that would be my answer to the stock picking question.
Okay, Tsepiso, I see that you would like another session just with regards to platform. We do have some ongoing educational content, platform specific on how to buy, sell, building a portfolio of stocks, swaps, bundles, baskets, and all the other functionality that's available, like the retirement annuities and tax-free savings. So keep an eye out for those. If you need something more immediate, we do have a YouTube channel that you can jump onto where we've got step-by-step videos that you can also use. Otherwise, just keep an eye out for those invitations to the live webinar sessions.
Great. Any more questions, fire away. Otherwise, we'll wrap up. And of course, this is available on YouTube. If you want to email the Coreshares guys, specifically drop a line to info@coreshares.co.za if you've got any ETF questions. And for the platform,
pop us an email at helpme@easyequities.co.za and you can reach us there. Great. Thank you very much for joining us today, guys. Thank you, Coreshares, for coming to give our investors some more knowledge, and we are hoping to see more. Yes, you just search Easy Equities.
Fantastic. Thanks, guys.
Thank you very much.